Imagine two people beginning their financial journey on the exact same day. They earn similar incomes, live similar lives, and have the same amount of money left over at the end of each month. One spends years searching for the perfect investment opportunity, waiting for the ideal moment to enter the market. The other starts immediately, investing a small amount consistently and letting time do the work. Decades later, the gap between them isn't created by intelligence, luck, or secret knowledge. It's created by consistency. One of the biggest misconceptions about investing is that success comes from predicting the future. People spend countless hours studying charts, reading forecasts, and searching for the next big winner. Yet history repeatedly shows that even professionals struggle to consistently outperform the market. The truth is that building wealth is usually less about making brilliant decisions and more about avoiding unnecessary mistakes. Before investing a single dollar, there is a foundation that needs to be built. High-interest debt acts like a leak in a bucket. No matter how much money is poured in, it continues draining resources away. Eliminating expensive debt often provides a better return than any investment available in the market. Once that burden is removed, attention can shift toward creating financial stability. Life has a habit of delivering surprises at the worst possible moments. Unexpected expenses, medical emergencies, job losses, and major repairs arrive without warning. This is why an emergency fund is so important. It serves as a buffer between financial setbacks and long-term investments. Without that protection, people are often forced to sell investments at exactly the wrong time, turning temporary market declines into permanent losses. Once the foundation is secure, the real engine of wealth creation begins. Compounding. At first, compounding feels disappointingly slow. The growth seems insignificant, almost invisible, but over time, something remarkable happens. Returns begin generating their own returns. The process starts small and gradually accelerates. Years later, the growth becomes larger than the original contributions themselves. What once appeared insignificant becomes powerful, simply because enough time has passed. The challenge is that human emotions rarely cooperate with long-term investing. Markets rise and people become excited. Markets fall and fear takes over. The instinct to react is strong, but reacting is often what causes the most damage. The investors who succeed are frequently the ones who remove emotion from the process altogether. They automate their investments, continue contributing regardless of market conditions, and refuse to let short-term events dictate long-term decisions. Instead of trying to identify a handful of winning companies, many successful investors choose a different path. They own broad sections of the market through diversified funds. This approach removes the need to predict which company will dominate in the future. Rather than searching for winners, they own the entire field and allow the strongest businesses to emerge naturally over time. Eventually, every investor faces a difficult test. Markets decline, headlines become frightening, predictions grow increasingly negative. It feels as though the safest decision is to step aside and wait for certainty to return. Yet, certainty rarely arrives until after opportunities have already passed. History has shown that some of the strongest market recoveries begin when fear is at its highest. Those who remain invested often benefit from the recovery, while those who leave frequently miss it. In the early years, many people become obsessed with investment returns. They spend enormous amounts of energy trying to gain a slightly better performance, while overlooking something far more important, their savings rate. The amount consistently invested often matters more than small differences in returns. Building the habit of investing regularly creates a foundation that becomes increasingly valuable as income grows over time. The modern world constantly competes for attention. Financial news, market predictions, and social media opinions create an endless stream of noise. Every day brings a new reason to feel optimistic or fearful. Yet, most of these stories fade away and become irrelevant. Long-term wealth is rarely built by reacting to headlines. It is built by maintaining discipline when everyone else is distracted. Perhaps the most important realization is that the wealth creation is usually far less dramatic than people expect. It does not require perfect timing, extraordinary intelligence, or constant action. Instead, it is often the result of simple behavior repeated consistently over many years. Small investments become large investments. Ordinary contributions become substantial portfolios. time transforms discipline into results. In the end, successful investing is not about predicting the future. It is about preparing for it. It is about creating a system that continues working regardless of headlines, market fluctuations, or temporary setbacks. The people who ultimately achieve financial freedom are rarely the ones who find shortcuts. More often, they are the ones who stay patient, stay consistent, and allow time to do what it has always done best: reward persistence.